The Dutch system does not offer a stepped-up basis. Instead, capital is taxed continuously throughout the owner's life, and the state takes a significant secondary cut upon death. To preserve capital in this environment, the American strategy must be re-engineered into a three-part life cycle: accumulate, leverage, and transfer early. Building a financial empire that survives for generations requires a strategy specifically engineered for the local tax code. In the United States, the ultra-wealthy rely on a three-step framework: buy appreciating assets, borrow against them for lifestyle cash, and hold those assets until death. This strategy is powered by the stepped-up basis. When an owner passes away, the tax cost of their assets resets to the current market value. Decades of unrealized gains are effectively erased, allowing the next generation to inherit the portfolio tax-free. In the Netherlands, this exact approach is a recipe for wealth depletion. The Dutch system does not offer a stepped-up basis. Instead, capital is taxed continuously throughout the owner's life, and the state takes a significant secondary cut upon death. To preserve capital in this environment, the American strategy must be re-engineered into a three-part life cycle: accumulate, leverage, and transfer early. Success in the Dutch fiscal system depends on the precise use of corporate structures and civil law instruments, rather than simple market timing. For a wealth builder starting at zero, the top marginal income tax rate is the first hurdle. Losing nearly 50% of your earnings to Box 1 taxes significantly slows the initial accumulation of capital. One solution is the Jaarruimte, or annual pension margin. By contributing up to 30% of qualifying income into a private pension, you receive an immediate tax refund at your highest bracket, essentially using pre-tax funds to build your foundational portfolio. This table shows the current transitional regime for Box 3 wealth. Under the permanent system scheduled for 2028, the state will tax unrealized gains on liquid assets annually. This means you will owe cash on paper profits even if you haven't sold the assets. To minimize this drag, investors split their holdings. Liquid index funds serve as collateral, while direct real estate is used for long-term growth. Unlike stocks, the value appreciation of real estate remains untaxed until the property is sold. Once personal assets exceed 500,000 euros, the tax burden of holding them in your own name becomes significant. At this point, wealth is typically transitioned into a personal holding BV. The BV acts as a compounding engine. Because it only pays tax on realized operational profits, unrealized gains within the company aren't subject to personal income tax, allowing the capital base to grow undisturbed. The challenge in the leverage phase is accessing the cash inside the holding BV to fund your lifestyle without triggering a 31% dividend tax. Current law limits how much you can borrow from your own company to exactly 499,000 euros. If your internal debt exceeds this excessive borrowing cap, the surplus is taxed as if you had paid yourself a dividend. This document outlines a specific exemption for primary residences. A founder can borrow unlimited amounts from their own BV to finance their home, provided it is recorded through a notarial mortgage, allowing untaxed corporate profits to fund their living environment. For liquidity beyond a primary home, the strategy shifts to external debt. By capping personal loans from the BV at 499,000 euros, a director can then secure a Lombard loan from a private European bank. This chart lists the parameters for these private banking facilities. By pledging the BV's investment portfolio as collateral, you access a line of credit. Since the debt is owed to an external bank, it does not count toward the internal borrowing limit. Combining a corporate mortgage with a Lombard loan provides the liquidity required to fund a lifestyle without liquidating assets or triggering personal dividend taxes. This table shows why waiting until death is the least efficient option in the Netherlands. For multi-million euro estates, the standard inheritance tax can remove up to 36% of the total value when assets pass to heirs. To prevent this, the strategy focuses on shrinking the taxable estate during the creator's lifetime by shifting the economic engine of the wealth to the next generation. This is achieved using a Stichting Administratiekantoor, or STAK, which is a legal entity designed to sever the control of an asset from its economic ownership. The founders appoint themselves to the STAK board to maintain all voting rights and corporate control. Meanwhile, they gift the economic rights to their children, ensuring the next generation benefits from all future growth. parents further reduce their estate using Schenken on Papier, where they formally acknowledge a debt to their children and pay a mandatory 6% interest annually. This moves cash to the heirs tax-free, while creating a deductible liability for the parents. Transferring economic rights early freezes the creator's taxable estate at its current level. This allows the entire family empire to grow for the heirs without increasing the parents' future tax exposure. Large transfers of corporate wealth often utilize the Business Succession Scheme, or BOR. By converting passive real estate into an active development company, families can qualify for a tax exemption of up to 100% on the transfer. The path to generational wealth moves from maximizing pension margins to sheltering assets in a BV, using private bank debt for liquidity, and eventually reducing the estate through a stack. While the American strategy relies on a single tax loophole, the Dutch model shows that multi-generational wealth requires a life cycle of continuous legal management to navigate a restrictive tax environment.